Hey there, my name is Ken. In this video today we're gonna talk about value stocks, value investing, and everything value as this channel is. I hope you'll get to know what value stocks are, examples of some excellent companies, and most importantly, how to find value stocks to invest in. Let's go ahead and first define what value stocks are. Value stocks are publicly traded companies trading for relatively cheap valuations relative to their earnings and long-term growth potential. Here's one important concept to understand for all investors. Most stocks are generally classified as either value stocks or growth stocks. Generally speaking, stocks that trade below the average of S&P 500 company is considered as value stock, while stocks with above average growth rates are considered as growth stocks. Simple as that. But the interesting thing is that some stocks have both attributes, or fit in with average valuations and growth rates. So whether to call them value stocks depends on how many characteristics of such stocks they have. Value stocks generally have some common characteristics. They typically are mature businesses, have steady growth rates, and have relatively stable revenue and earnings. Most value stocks also pay dividends, but this is not a rule, not all of them do. All these remind me of safe stock that we reviewed recently. If you want to check out them, they are here. Some stocks clearly fit into one category or other. For example, 130-year-old spice manufacturer McCormick is clearly a value stock, while fast-growing Tesla is an obvious example of growth stock. On the other hand, as I said above, some stocks can fit into both categories. For example, there's a case to be made either way for tech giants as Apple and Microsoft. However, that a stock is classified as a value stock by someone doesn't necessarily mean it's a good value. That's where your analysis must come in. We'll be talking about analysis a little later on this video, so keep watching. Now let's take a look at three excellent value stocks which I met a lot while I was doing my research. They are Berkshire Hathaway, Procter Gamble, and Johnson & Johnson. Let's review them in detail. Why are they considered as value stocks? Before we dive in, just make a quick trade of the like button, invest in subscription to the channel for more useful content. You can also buy me a coffee, the link is down below in the description. So here are the three excellent value stocks for beginners. The first one is Berkshire Hathaway. Since Warren Buffett took over in 1964, Berkshire Hathaway has snowballed into a conglomerate of more than 60 wholly owned businesses and a massive stock portfolio with more than 50 positions. Berkshire has steadily increased its book value and earnings power over time and currently still operates under the same business model, which has led the stock to more than double the annualized return of the S&P 500 for over the 55 years. Second company is Procter Gamble. Consumer products manufacturer Procter Gamble owns some of the most recognizable brands in its various industries. If you know brands such as Gillette, Tide, Bounty, that's the Procter Gamble behind all of this. And there are dozens more in its portfolio. Through the success of its many brands, Procter Gamble has been able to increase its revenue steadily over time and has become one of the most reliable dividend stocks on the market because it's been increasing its annual payout for more than 60 consecutive years. The third excellent stock is Johnson & Johnson. The healthcare giant is best known for its consumer healthcare products, such as the Band-Aid, Tylenol, Listerine, just to name a few. But the majority of its revenue comes from pharmaceutical and medical devices business. Healthcare is one of the most recession-resistant industries, and Johnson & Johnson has produced steady revenue growth over the years. Before we get into the topic how to find these value stocks, here's one more important thing for investors to understand. That's the difference between value stock and value investor. A value stock is a company to which traditional methods of fundamental analysis can be applied. A value investor, on the other hand, refers to someone with the primary investing goal of identifying good companies that are trading at a discount price to their intrinsic value. Long-term investors can generally be classified into one of three following groups. Value investors try to find stocks that are trading for less than their intrinsic value by applying fundamental analysis. Growth investors try to find stocks with the best long-term growth potential relative to their current valuations. And investors who take a blended approach do a little bit of each. There have been several famous value investors. Warren Buffett, perhaps the best known value investor of all time, and has a proven track record of investing in stocks and even entire companies at significantly less than their intrinsic value. The proof is in the performance. From 1964 to 2019, that's the last information I found, the S&P 500 has generated a total return of 19,784%, while Berkshire's total return during the same period of time was 2,744,062%. Another value investor is Benjamin Graham, who often referred to as the father of modern value investing. His books Intelligent Investor and Securities Analysis is a must-read for value investors. And Graham was actually Warren Buffett's mentor. Now let's talk about how to find value stocks to invest in. Unfortunately, finding stocks that trade for less than they are truly worth is easier to say than do. After all, if it was easy, everyone would be rich. Anyways, that said, here are 3 of the best metrics to keep in your toolkit as you search for hidden bargains. The first is PE ratio, which means price to earnings. This is the best known stock valuation metric, and for a good reason. The price to earning ratio can be a very useful tool to compare companies in the same industry. To calculate it, simply divide company's stock price by its last 12 months earnings. The next one is PEG ratio, price to earnings to gross. This is similar to PE ratio, but adjusts to level the playing field between companies that might be growing at slightly different rates. By dividing a company's PE ratio by its annualized earnings growth rate, you get a more apples-to-apples comparison between different businesses. And third metric is price-to-book ratio. Think of the book value as what would theoretically be left if a company ceased operations and sold all its assets. Calculating a company's share price as a multiple of its book value can help identify undervalued opportunities. And many value investors specifically look for opportunities to buy stocks that trade for less than their book value. Many experienced investors say to not underestimate the power of value stocks. While they might not be as thrilling as their growth stock counterparts, it's important to realize that value stocks have as much potential in the long term as their growth stocks, if not more. After all, a $1,000 investment in Berkshire Hathaway back in 1964 would worth more than $27 million today. Finding companies that trade for less than they are truly worth is a time-tested investment style that can pay off tremendously well. That said, hope I was useful for you guys. Drop a comment if you are a value stock investor or growth stock investor or both. I am probably a mixed one. Here are more other videos about personal finance and investments. Make sure to subscribe to the channel, like the video and hit the notification bell. See you in the next video.